Hey, welcome to this episode of Value Invest You. Today we're going to be doing a deep dive into a 50-year analysis of the S&P 500 index. So I've listed a few companies here that have S&P 500 index ETFs that are traded on the stock market. And what I wanted to go through in this video is the benefits of investing in them, some of the potential short-term pitfalls you could be into, and really the benefits of investing early and looking at the returns over time. Okay, so for this scenario analysis, what I did was I assumed that you could start investing at any given month. I looked at two approaches. One is a lump sum approach, where we put at any given month a lump sum of money in the S&P 500, buying an index fund. And the second approach that we take here is regular investments into an index fund. What I'm assuming is basically $500 per month, starting at any month, at any point in the market, and looking at what those returns are. So I've done an approximate 50-year history here. I started at the time where the gold standard was abolished, as I figured this is a very critical point in the macroeconomics of the index fund and of the US dollar. We're looking at 1, 5, 15, and 25-year projections. The reason why I picked 15 and 25 is a 15-year investment I figured was a typical time frame for saving for kids' education, and 25 years is a critical time for saving for retirement funds. Under each scenario, what I looked at is the likelihood of losing money in each case, and what are sort of the min, max, and average gains for the index over that time. Okay, so getting into the first case. So again, this is starting at any month in over a 50-year history, putting in a lump sum of money, and what's the return that we get. So we see the minimum return we would get, we'd lose about 46.68% of our fund. And this is really where you would be investing in the highs of the market, and you hit a crash suddenly after that, basically a year into that. So when I look at the events that are on sort of the lower end of the spectrum, and that's where you have a min return of 46.68%. So the events that have taken away about 40 to 30% of the value are the dot-com crash. There's several instances when we went through the financial crisis in 2008, and then also the stock market crash of 1973, 1974 would yield somewhere in a area of taking away 30% of your portfolio. Now, when I look at some of the max returns where I have potential gains of 60%, the way we're able to get that is actually investing in these crashes. So really it's coming out of those crashes. So in 1974, if we had invested at the absolute lows of the market in the 73, 74 stock market crash, we could get returns as much as 60%. Same thing with the dot-com and the financial crisis crash. Investing a lump sum at the stock market lows really yields a long-term if you're able to sort of time the market correctly, which is why I've done the next case scenario where we're looking at regular investments in the index over time. So we have an average one-year return of 9.47%, a median of 10.95%, with a standard deviation of 16.7%. So with that standard deviation, given that it's bigger than the average return, the probability of having a positive return, again, starting at any month over the past 50 years, is 75.4%, and that results in a negative return probability of 24.6%. Again, it's injecting capital in the market at any point over the past 50 years and watching it grow for a year. Now, if I was to do a regular investment of $500 every month, and I started at any point in the market over the past 50 years, the minimum return I would get is a little bit better than the impact of a minimum return that I would get if I just injected the capital at any point in time. So that shows sort of the smoothing effect. So we would lose about 30%. Again, that's investing right before a market crash. The market crashes are the same situations as we saw previously. And same thing with the max return. If I start investing at market lows and I start riding that curve up, I could have some pretty big returns. So the statement that Warren Buffett makes, where it's be greedy when others are fearful and be fearful when others are greedy, is absolutely true for this thing. We want to try to invest as much as we can when we're in our market crashes. The average return is a little bit better than the average return when I do the lump sum investing. I get about a 14% average return at any point in the market, with a standard deviation of about 641 per year. So that gives me a probability of a positive return of 88.6% versus the probability of a positive return of only about 75% when I just inject capital. So that translates into a probability of a negative return of 11.4%. And the probability of beating inflation, which I'm looking at about a 2% inflation per year, is about 85.6%. Okay, now we're going to look at the case where we invest money and hold it for 5 years in an S&P 500 index. Now we'll see that the minimum return and maximum return, or minimum return is less, maximum return is a little bit more than what we've seen in the 1 year case. And same sort of thing. If I look at timing, for the negative 35.01% return, that would happen where I'm investing leading up into a crash. And I'd be looking at my money in the account during a crash. So I could lose 35% of the value. And again, that's for some key historical crashes over time. Max returns would occur when I'm investing a lot of capital at the bottom of a bear market and riding and transitioning into a bull market. So really important, again, to keep investing while we are in the bear markets and put as much money in as we can. We'll see the best returns. So an average return of 52.94%, and that results in a CAGR of 8.9%. We have a median return here of 54.08%. with a standard deviation of 51%, which is fairly large. So that gives us a probability of a positive return over a 5-year period of 80.4% and the probability of a negative return as of 19.6%. Okay, now going through the regular investment case where, again, I pick any point in the market to start in. I invest $500 over a period of 5 years and invest those $500 each month. So the total value of my funds I've invested is $30,000. And the minimum return I'd have, again, if I was in a bear market and I looked at my portfolio, I would have a negative 40% return. So I'd have only about $18,000 left. The maximum return I would have is about $59,000, where it's about a 42% return. And the average is about $38,000, which gives me about a CAGR of 5%. So I'm not doing too bad in terms of rates year over year. The median return is, again, about $38,000 with a standard deviation of about $7,500. So my probability of a positive return, because I've done that smoothing effect and I've injected capital on a regular basis throughout the market, is about 88.6%, giving me a probability of negative return of 11.4%. And the chances of beating inflation, again, assuming a 2% rate of inflation year over year, is about 82%. Okay, getting into the 15-year case, and again, as I'm going through this, we're going to see the numbers are getting better and better in terms of minimizing that risk. And the reason why it's looking better and better is I've gone into bear markets, I've come out in bull markets, and now that I'm looking at a 15-year return, in some cases I've actually hit 2 bear markets. So when I think of a couple key bear markets, the dot-com crash happened in 2000, the financial crisis happened in 2008. So my minimum returns is really when I invested at the peak right before the dot-com crash, and I've hit those 2 bear markets, and I'm looking at the value of my fund right in the middle of the bear market of the financial crisis in 2008, 2009. So my minimum return now would be 26.5%. Again, that's lump sum investing. My maximum return is 817%, and that's looking at investing money in those bear markets again. My average return is 261.40%, giving me a CAGR of 8.9%, median return of 237%, with a standard deviation of 180%. So now I see my probability of a positive return over this cycle is 100%, and probability of negative return is 0%. So this shows that investing in an index fund over time, really, as I enter in bear markets and bull markets, I shouldn't care too much, provided that I'm investing for the long term, because I see that my chances of actually having a negative return go to 0 as I spend more time in the market. Okay, so as you know, not everybody has the luxury of just putting a lump sum into the market wherever they feel. We again look at the case where we're doing a $500 regular investment. So in this case, because I've done that over a 15-year period, I have $90,000 invested in the market now. So my minimum return, again, looking at my funds in the middle of a bear market for the financial crisis, where I've gone through two of them, I'd have a total value of $70,735, which is a 21% loss. My maximum return would be 286%, so a little bit less than what I saw for the lump sum case, and I would have about $347,000 in my portfolio. So average return over this 50-year period is I'd have about $189,000 in my fund, which gives me about a CAGR of 5%. Median return about 176,000, standard deviation of about 60,000. So my probability of a positive return has shot up quite a bit in comparison to the 5 or 1 year cases. I have a chance of 97.9% for having a positive return, which obviously translates into the probability of a negative return of 2.1%. And the chance of beating inflation at 2% is 92%. So really, really good numbers over a 15-year cycle here. Now, one note on the CAGR of 5% return. So I did a video on the S&P 500 index funds, and I did a long duration in those funds to look at how it grows over time. And what you'll see is when we take incredibly long durations, we do get a CAGR of about 5% for the index. But that translates into about a 8 or 9% return for the index itself when you factor in the dividends that get paid out. So in reality, we may see something around the 5% mark here for the overall index, but the returns we would get when investing in an index fund would be slightly higher. Okay, so let's look in the 25-year case. Again, cases for the minimum are looking at our account in the middle of a bear market. We still see that the minimum return is about 326%. Maximum return is 2,043%. And again, that was the case where I put a bunch of money into a bear market, and I'm looking at the value of that money coming out of it 25 years later. Average return is 749%, giving me a CAGR of 8.9%, a median return of 594% with a standard deviation of 335%. So in these cases, I've gone through a couple of bear markets, a couple of bull markets generally for a 25-year return. And the probability of a positive return in this case is no surprise, given it was for the 15-year case, is 100%, and probability of negative return is 0, of course. So let's look at the case now where we're doing $500 regular investments over a 25-year period. And I'm starting to see some positive trends here because I'm actually returning a profit in every case here. I've put $150,000 into the market over my total lifetime here. This is kind of retirement fund cases. And the minimum return I would get is $231,000, about 54%. My maximum return I'm getting is about $1,142,000, which is about a 662% gain. And my average return is about 258%, giving me a CAGR about 5.2%. Again, as mentioned, the index funds will probably give you a better return when you factor in dividends, but this is the average rate for the index itself. So I have a median return here of $496,000, a standard deviation of $233,000, and now a probability of a positive return of 100%. The probability of beating inflation is 100%, so the money I have invested here is definitely worth more in the future, and we're beating that rate of inflation, so I'm not losing value over time. So in summary, for looking at these cases for the S&P 500, really there are huge benefits with putting in your money over the long period. This really reduces your risk of having a negative return. Key takeaway for me is the more money that you can put into a bear market, the better you're going to be, the better growth rates you're going to see for your fund over time. And regular investments of $500 help smooth the curve over the short term. So when we're looking at that 1 year or 5 year case, we see that we actually we reduce our chances of losses We don't have as big of gains in certain cases, but we mitigate that risk of having bigger losses in our fund with regular injections of capital. And that's really important, as well as we don't know really where the bottom of some bear markets are going to be. But again, if we can still put money in at regular intervals, that's going to help sort of reduce our overall burden in bear markets. Thanks for checking out this episode of Value Invest You. Don't forget to click subscribe below and visit us at valueinvestyou.com for more videos and information.